Alibaba, one of the most controversial businesses that I've ever invested in. If you're part of the value investing community, you love this business. You're like, oh my gosh, this thing is extremely undervalued. If you're literally anybody else in the rest of the world, you're looking at these businesses to invest in, you're like, I don't want a part of this thing at all. I don't want to be anywhere close to this business. Thing is just looking terrible. If we look at Alibaba, just the chart of how it has looked in the last year or so, from the peak of October 2020, it is down 30%. If we do a 1 year view, it's down almost 40% since October of last year when it peaked, when it hit its max number, like $319 a share. And since then, it's just been on this steady decline. Like it's had moments where it was like, oh, I'm about to nope. And it just like nopes its way back down. And it's like, what is going on? Is the business failing? Is the business doing bad? It's like, what is exactly going on? If you look at the actual numbers of this business continues to improve. Like you keep looking at all the numbers. It's like from 2019, which was the last time that Alibaba has traded at these levels. If we go to the 5-year mark, Alibaba hasn't traded at $170 since 2019. And if we look at the business where it was in 2019, it has 721 monthly active users on its websites. Now it has 925 million. If we look at the amount of revenue it's bringing in now, it had 55 billion in revenue. Now it's bringing in 107 billion, almost double what it was doing just 2 years ago. And so the question is like, this is not something to do with the business aspect of Alibaba, because when you look at the business, everybody understands that Alibaba is a good business. There's nobody out here that will argue with you on that. Everybody will say this is a good business. However, there are risks associated with investing in Alibaba. As you guys know, I've put a good chunk of my money into it. I mean, if in my M1 Finance account, I have $1,000 put into Alibaba. Now that $1,000 is now $843 as it's seen a massive decline in the last couple of weeks. And in my Robinhood portfolio, I've been buying in heavily. I bought over $2,000 of Alibaba with my own money. And now that's actually down $198, which it means that it's actually way higher than that. So I've put a good chunk of money into it. As a matter of fact, Alibaba makes up about 25% of my total single stock portfolio. It makes up about 25%, and that number is going to climb. And so the question is, why am I seeing all these risks? And I'm going to talk about what the risks are with investing in Alibaba and still investing into it. I'm just going to go ahead and tell you why at the beginning of this video before we go into all the other things. Because at the end of the day, I'm not somebody who focuses on all the macro. I'm somebody who focuses on all the micro, which is the growth of the actual business. And the business itself looks great. However, it doesn't mean that we ignore the macro. So in this video, we're going to talk about all the macro of things that are affecting Alibaba and why I am not that worried about them. All right, let's get into it. Whoosh. What's going on, people? It's your boy Kalechi back with another video. If this is your first time around these parts, hit that subscribe button. If you enjoy anything that we talk about on this video, hit that like button. Turn that thing, say it with me now, blue. But anyway, like I said at the beginning of the video, we're going to be talking about the three main risks that I see investing in Alibaba. And we're going to start off right here with number one. The first risk that everybody seems to talk about when talking about investing in Alibaba is the risk of the United States deciding, you know what? We don't want none of y'all Chinese companies anymore. We don't want none of y'all to be on our stock market. We don't need none of that. And so everybody's freaking out about the possibility that the United States government will actually delist companies like Alibaba, Tencent, JD.com, and all these other Chinese companies from the United States market. However, is it a possibility? Well, yes, it's always a possibility. There's always a percentage chance that this can happen. But is it a probability? Probably not. Because one of the things that just got released by the SEC is some of the requirements that it has for Chinese companies to make sure that they're reporting numbers in the right manner. Now, the question is, has Alibaba actually been doing this? The answer to this is yes. Alibaba has been using PwC, which is big multi-firm to actually audit all their numbers, which is one of the requirements that the United States has for any Chinese companies to make sure that they're being audited by an American company to make sure that their numbers are accurate so that investors aren't being deceived. And so they're being audited by PwC, Pricewater something. I forget what the C stands for, but basically they're auditing them. So the question now is, do you actually believe the numbers that PwC is auditing them on? If you don't believe them, then you can't invest in Alibaba. However, if you don't believe PwC, then you might as well remove half of the companies on the S&P 500 from being invested in. You might as well not even invest in the S&P 500 because PwC handles a lot of companies' audits. I mean, even for my company, the company that I work for in the United States, our auditing process for all our financials is done by PwC. So my question is, if you don't believe those numbers, then you might as well not invest in the S&P 500. You might as well not even invest in any company in the United States because it means that you don't believe any of the numbers from any of the auditing sources. So with that being said, that's not really a risk. So let's move on to risk number 2. The second risk that everybody has is with the VIE/ADR structure. This is the fancy structure that Chinese companies have to go through in order for them to get international funds, in order for them to get international investors into those companies. And the fear is that the Chinese government can wake up one day and decide, you know what? We don't want any more international investors. We don't want you guys to be able to invest through this structure and basically make that structure illegal for anybody to invest in this structure. Now, is it ideal for us to be investing in a company through this kind of structure? No. However, the question that I have for everybody who keeps on talking about like ADR structures and all this other stuff is like, well, we see it with so many different companies. Like, it's not the first time, like Shopify. It's basically the same kind of structure. In order for you to buy Shopify, it's not listed on the US stock exchange. Shopify is listed in Canada. If we look at Shopify, Spotify, we look at Royal Dutch Shell, a lot of companies use this ADR structure. Now, the fear is the Chinese part of this. Now, could it happen? Is it probably? Is it possible? Yes. Is it probable? I don't think so, because the one thing you also have to think about is if China decides that this kind of structure should no longer be allowed and investors can no longer invest in their companies through this manner. They don't want any international investor investing in this company structure like this. Well, what they're basically saying is we don't want to deal with anything internationally. And you know one thing that China definitely does not want to do? Exactly that. You know how I know that they don't want to do this? There's something called the Belt Road Project that China has been implementing and putting into practice in a lot of different places overseas. In 2019, I traveled to Nigeria. And one of the things that I noticed when I was in Nigeria was a lot of Chinese investment going on in Nigeria. What does that mean? It means that they are expanded. In other words, they don't want to close off their borders to international investment. So I don't think that this one is that much of a possibility. This one does not really scare me that much. Like, yes, I'm bothered by it that I don't really get access to the actual company, which the ironic thing is I've been hearing a lot of people say this noise about you don't get to vote on anything for the company. Because remember, when you become a shareholder in a company, you become an owner of that company. That's not true, because the other day I just got an email where I was able to vote on who should be part of the board of executives for Alibaba. So needless to say, which is one of the things that I really enjoy about investing in companies, needless to say, you can still do all of that stuff. So all the other noise that people talk about, I don't know where people are getting that information from, because as a shareholder, I actually got some emails and I was like over here on my computer getting excited because I had the opportunity to actually like fill out my ballot and select like yes, no, and all that good stuff. Not to say that I actually knew any of the people on the names, but regardless, the point was you can still vote on a lot of issues concerning the company. So that's thing number 2. Now, the third and final risk involved with investing in Alibaba. I'm so excited. I'm sweating. Like, then again, I'm in Georgia and it's hot. It's hot. I live in Georgia. It's hot. I'm sweating. I'm very excited to talk about this. But anyway, the third, and I think the only risk that I am truly afraid of was something that a friend of mine said. She makes amazing content. She writes, she makes TikTok, she makes YouTube videos. I'm gonna put a link down in the description to all her stuff. And she brought up an unbelievably good point that I had not thought about, that I had not focused on, that my bias has clouded my eyes to. And this is one thing that for all value investors, we have to keep in mind. A very subtle but very important bias that we may have. And in the article, she actually wrote a really good article of just like how we see Chinese companies versus how the Chinese government sees Chinese companies, because it's very important to always factor in the CCP, because the CCP, they don't play. Like, they take control very seriously. So we've been seeing a lot of business crackdowns recently from the Chinese government. They've been doing a lot to make sure that they're putting everything in the right scope, which I don't think regulation is a bad thing. A lot of people hear regulation and they freak out. I think some of our countries here in the United States need to be regulated a little bit stronger. Like, a lot of companies just been doing whatever they want. We've seen what happens when we let the inmates run the jail yards. I mean, look at financial crisis of 2008. That's because we didn't have enough regulation in place to limit what the banks were doing, but we're just letting them do whatever. So I don't think regulation is a bad thing. And I think that China is trying to put some of those regulations into place. But, you know, whenever anybody mentions the word regulation, everybody freaks out. But anyway, something she said very, very, very coolly and very nicely in her article, which I'm going to have a link to this down in the description. She said, the deal is that there is an overexposure to Chinese companies in the EM indexes. By the way, this article is not specifically talking about Chinese companies or anything like that. She was just talking about how indices are managed. And then an increased exposure to them due to market cap weighting resulting in funds having overexposure, resulting in asset managers having overexposure. And so China wants to invest in hard tech, and they're going to redesign their stock market to make that happen. There are a multitude of other reasons for all of this, but the main thing, China does not see tech as the US sees tech. However, US tech investors invest in China tech the same way that they invest in US tech. There was an underpricing risk of Chinese stocks, resulting in a feedback loop of indices, funds, and asset managers all being overexposed. I think the main takeaway is, like, we here in the United States do not see necessarily we don't have the same viewpoint, or we don't see things the same way as the CCP. Like, for us, the ultimate companies are software-based companies. Those are internet-based companies, software-based companies are the companies that dominate. Like, if you look at the S&P 500, if you look everywhere, the biggest companies right now are internet software-based companies. Those are the companies that have the ultimate margins. However, for China, especially for the CCP, that's not how they see it. They want to dominate with hardware-based companies. And so they will make things and contort things to make that be their future, to make them be the kings of chip manufacturing. Right now, the king of chip manufacturing is Taiwan. But they want to take that place. They want to rule over that. They want to be on the forefront of dominating that field moving into the future. And so if they have to play around with their stock market so that they can contort and get labor to go away from companies like Alibaba and Tencent and JD.com and move into companies that are developing chips and those kind of things so that they get the talent, I think they're willing to do that. And I think this is the real risk that we face as investors. Now, do I think it's actually going to happen? I don't think so. That's why I'm putting so much money into Alibaba. But at the same time, it is the risk that we face with investing in any Chinese company, especially when you talk about Alibaba. But as far as the other ones, the other two risks that I mentioned earlier, I don't think they're much of any risk. But even with this risk, the reward potential, because it's not like this is going to completely stop Alibaba. Alibaba is on a roll of growing. Like, they made some more announcements today where AliExpress is going to be more available elsewhere. So they're continuing to expand. So that's not going to slow down Alibaba's growth or anything like that. Eventually it might, but it's not going to do it immediately. And so for me, I'm going to continue buying into Alibaba. Like I said, now it makes up about 25% of my portfolio, but that's going to grow. That's probably going to be about 35%. If these prices remain under $200, y'all boy going to be buying. Y'all boy going to buy. It's probably more of a problem that I keep buying into this company when I really should, like, take a step back. But I can't help myself. I'm going to be buying heavily into it because, as Warren Buffett said, when you get an opportunity, you have to go big. You have to go big. Now, could it go to zero? Yes, but I'm willing to take that risk. It's a risk that I am willing to take. But anyway, that's all I got for y'all on this video. I hope y'all learned one, maybe two things out of this entire thing. And if you did, hit that like button. If you enjoyed it, hit the subscribe button. But I'm gonna catch y'all up on the next one. Remember, generosity is always greater than greed. God bless each and every single one of y'all. And y'all boys out of here. Peace.